All right, so my name is Michelle Sulik. I'm a community affairs specialist with Elevations Credit Union. I am looking forward to today's presentation. I'm going to start by reminding you that your questions are very valuable. We love these webinars to be interactive and to really provide solutions for you or on the questions that you have. So please enter them in the Q&A button at the bottom of your screen, and I will be facilitating these questions today for Erin. I would like to start with introducing Erin, but before I do that, I have a story that I want to start with, and it's a very true story. So my daughter's boyfriend is being stationed at Buckley, and he has a housing allowance, and we started looking for a home down in Denver, Cherry Creek area, Aurora. And we found a house, beautiful, perfect house for them. We put an offer in, or he put an offer in at much to guidance, made a really high offer, but there were 6 offers on the first weekend, and it came down to Tom's and another's, but he ended up losing on it because they waived the whole inspection. The other couple was so desperate to get this house. So now they've moved to condos and townhomes, and they're looking at their opportunities to buy in Denver. And so this video is going to be shared with them. So it's prime time, Erin, where people are just really looking at all their options. So today, I hope that we can answer some questions. So with that, it is my extreme pleasure to introduce you to Erin Staufer with Elevations Credit Union, Senior Mortgage Loan Officer with Elevations. And I have to give a shout out to him because he was not scheduled to do this presentation, and he really saved the day and just got everything together and was able to present for us today. So thank you, Erin, for that. Your knowledge is vast, and I learn, and I'm looking forward to learning right along. So with that, well, let's go ahead and get started.
Beautiful. Thanks, Michelle. All right. So a little bit about me. I've been doing mortgages now for 12 years. Prior to being in the mortgage industry, I had my real estate license. So I was a real estate agent. If you're doing the math, that means I got my real estate license in 2008, 2009, which was the worst possible time to get your real estate license, which is why I'm now on mortgages. Real estate was tough, but mortgages have been great. If I'm not doing mortgages, and right now it's probably about a 60-hour-a-week job, I love to go on motorcycle rides with my dog Finian. He's the Irish setter. He is a prince. This is his chariot, and I am simply a chauffeur. It's his world. I'm just living in it. And I like to do yoga and play soccer, and that's a little bit about me. I am technically a mortgage sales manager, but I'm an originating sales manager. So in addition to managing a group of loan officers, I also originate loans myself. Today we're talking about condos, townhomes, HOAs. Before we get into all of that, we're going to be taking a little bit of a step back, and we're going to be reviewing a number of different loan terms, discussing the different types of loans as well. I promise you, if you can bear with me through that, we'll get to the nuts and bolts of the presentation. It is relevant because it actually is kind of the driving factor and the driving component around why we have this class as a whole. Condos and townhomes are a little bit unique, and different types of loans treat them differently. So taking a little bit of a step back, giving you a very high level view of different loan terms and the types of loans. And then we're going to be talking about what is a condo versus a townhome, what are HOAs and management companies, what function do they each serve in the process, what is the lender concerned about when it comes to buying a condo or a townhome, and then what are your considerations? What should you be on the lookout for if you were looking to buy condos and townhomes? So without further ado, let's get to it. Couple quick loan terms they're going to hear me throw out. One is what we call LTV, loan to value. Fortunately, I think I'm talking to a lot of numbers people, but the loan to value is your loan amount divided by the price of the collateral, which is the property you're buying. So if you have a loan amount of 100,000 and your house is worth 200,000, your loan to value, or LTV, would be 50%. Okay. Debt to income ratio is another component that the lenders care about. They don't just care about your down payment, but they also care about your debt to income ratio. The debt to income ratio, and there's actually a couple different types of debt to income ratio, but primarily we're going to be talking about one of them, which is your total monthly expenses, including the new housing payment. So your new housing payment, car loan payments, student loan payments, credit card payments, anything that would show up on the credit report. Okay, we only really care about the things that show up on your credit report. Take those monthly payments and divide it by your total gross monthly income. We care about your gross monthly income, not the net monthly income. So we care about how much you're making before expenses, before taxes, before 401k contributions, that type of thing. We care about your pre-tax number. So total monthly payments, including the new mortgage payment, divided by your gross monthly income. Lenders typically want to keep that below 45%. Again, it depends a little bit on the type of loan. We're going to be looking at that in just a couple more slides. In this example real fast though, if you have $4,000 per month in income and you've got $1,550 per month in debt, your debt to income ratio, or DTI, debt to income ratio, would be 38.75. Okay, $1,550 divided by 4,000. Okay. Another couple terms for us. PMI or MI, which is private mortgage insurance or mortgage insurance. You'll sometimes also see it abbreviated MIP, mortgage insurance premium. They're all the exact same thing, which is the one type of insurance that does you no good. Okay, it's not insurance that benefits you. It's insurance that you pay for that protects the lender. Anytime you put less than 20% down, it is a necessary evil. It protects the lender from default. If you defaulted on a mortgage and you put less than 20% down, the mortgage insurance would protect the lender down to that 20% threshold. Credit score, kind of an obvious one, right? Is the rating of one's likelihood of default by the 3 different credit bureaus. Specifically, we look at TransUnion, Equifax, and Experian. Sometimes people are hooked up for Credit Karma. We call those fake O scores, not FICO scores. FICO scores are Fair Isaac and Company or Fair Isaac Corporation. That is the standardized algorithm that lenders use to calculate a credit score. Okay. The FACO scores like Credit Karma, they use their own specialized algorithm to calculate credit scores. So I have people all the time who are like, yeah, my credit score is a 950 according to Credit Karma. I'm like, yeah, that doesn't exist on the FICO model. The FICO model tops out at 850. I've never seen anybody at 850. The highest I think I've ever seen was like an 825. So just keep that in mind. If you are signed up for any of those alternative credit calculations, they're good at projecting trends. Hey, my score is improving, or hey, my score is going down. But as far as actually predicting the actual credit score, they're less successful at that. You can also get a friendly tip, a free credit report at annualcreditreport.com. You have to pay for your credit score, but they will give you your credit report for free, so you can see what's on there. Worthwhile to do every couple of years if you're not extending credit and you don't have access to your credit elsewise. Last summary terms page, okay? So when your loan closes, it gets split into 2 pieces. The note, which is your promise to pay, and the servicing rights, which is who you make your payments to. When people talk about their loans getting sold, they're talking about the servicing rights. Who do I make my payments to? Who do I deal with on a daily basis? With elevations, and it will differ institution to institution, we're going to sell the promissory notes the majority of the time to Fannie Mae or Freddie Mac or FHA or VA, but we retain the servicing rights. So elevations is who you would call if you had questions on your mortgage. You would call the mortgage loan officer that helps you out. Okay. So promissory note is your promise to pay. I promise to pay X amount at this interest rate for this length of term. That is the piece of paper behind the loan. That's the part that gets sold off to Fannie Mae and Freddie Mac. That's the part you don't really care about. We don't really care about that piece just because they don't really have any piece of it once they close. You will get one letter after closing saying, hey, we own the piece of paper behind your loan, first and the last time you ever hear from them. You will never hear from them again, okay? The investor would be Fannie Mae or Freddie Mac or FHA. That is the government-sponsored enterprise or the guidelines that is behind the note. Who's acquiring the piece of paper? Who's acquiring that promissory note? Who is setting the guidelines by which we have to adhere? Okay, so if we sold the note off to Fannie Mae was the investor. They are the ones that establish those guidelines that we have to abide by. Servicing rights, again, who do you make your payments to? Who deals with escrow analysis? Who generates the tax statements after the end of the year? Who handles the actual processing of your payments? Okay. All right, so mortgages are put into 3 different buckets. These are 3 different investors, okay? Now you can see why we go over some of those loan terms. If I started here, people would be confused. So there's 3 different buckets that loans fit into. Conventional loans means that the investor behind the loan is Fannie Mae or Freddie Mac. They are objectively the best type of mortgage. It is plan A. We go conventional if we can go conventional. They've got the most generous loan terms, the best types of mortgage insurance, the easiest guidelines. They are objectively so the best type of mortgage. Conventional loans include Fannie Mae and Freddie Mac. Second type of bucket is what we call GOVs, or government loans. FHA, Federal Housing Administration, USDA, U.S. Department of Agriculture, VA, Veterans Affairs. That is actually Uncle Sam's money. Fannie Mae and Freddie Mac are government-sponsored enterprises that are supported by the government, but it's not actually the government themselves. Not the case with these government loans. FHA, USDA, VA loans, that is actually Uncle Sam's money. The third type of loan is what we call a portfolio loan. Okay, portfolio loan is anytime it's the bank's own personal money that they are lending out. I joke all the time that banks and credit unions are very quick to lend out the government's money, these first two buckets, and a little bit slower to lend out their own. Okay, anytime you've gotten a credit card, that is a portfolio loan. It is the bank's institution's own personal money that they are lending out. Okay, car loans, same thing. It is their personal money that they are lending out. Personal loans, same thing. Mortgages are a little bit unique in that there's a lot of investors behind the mortgages. So with the conventional loan, that's what we're focusing on here, the first bucket, option A, preference A. Fannie Mae and Freddie Mac are the investors behind the loan. They are the government-sponsored enterprises. As a first-time home buyer, you can put as little as 3% down on a house as a primary residence. As a repeat buyer, you have to do 5% down. If it's an investment property, you have to put a minimum of 20% down. Okay. With conventional loans, they typically require a 680 credit score. They do have slightly more rigid credit requirements as opposed to the government loans, which we're going to look at next. Max debt to income ratio. We talked about debt to income ratio in one of the previous slides. They want to limit that debt to income ratio at 45%. They will go up to 50% if you have what we call compensating factors. Yeah, you know, my debt to income ratio is a little bit high, but I have a lot of assets left over. Great, that's a compensating factor. Or I'm putting a lot of money down. That's a compensating factor. So 45 to 50% debt to income ratio, depending on the compensating factors that are available. Advantages of conventional financing. Cheaper mortgage insurance. Mortgage insurance is less expensive. The mortgage insurance is either monthly or one time, but you do not have to pay both. So it's one or the other. Huge advantage when we look at government loans, you'll see that's not the case. More property flexibility. Arguably the most property flexibility. They are not super concerned about health, safety, and livability concerns, so long as it's not obvious. If there's holes in the roof, conventional is going to struggle with it. But typical deferred maintenance, conventional financing does not care. They assume you're an adult. They assume you're going to take care of it. They're not super concerned about it. So anything obvious health, safety, or livability concerns, holes in the wall, exposed wiring, exposed plumbing, holes in the roof, settling issues such that it might pose a tripping hazard, conventional is going to raise their hand and have an issue with it. But generally speaking, they have a lot of property flexibility. Easier process. Again, I'd argue probably easiest process. Not a lot of government hoops to jump through. Cons, downsides to it. Tighter credit requirements. They want to see a 680 credit score. Anything over 680 is considered good. Anything over 740 is considered perfect. So if you're over 740, congratulations, you're perfect. Slightly higher down payment requirement if you're not a first-time home buyer. Repeat buyers have to put 5% down for a primary residence. FHA, we're going to look at that next, requires 3.5% down. So slightly higher down payment requirement. Also, they have longer wait times after serious delinquencies. If you've had a foreclosure, they're going to require 7 years to go fast. So they do have some longer wait times after serious delinquencies. Government loans, GOVs. So the investor behind the loan is the actual government. We're going to be focusing in this case on FHA. It's the most common one in this area. We do VA loans as well. There's just fewer veterans in this area. If we were up in the Colorado Springs area, we'd be only dealing with veterans almost. So it really just depends on what market you're part of and, you know, kind of who makes up that market. FHA was for the longest time considered a first-time homebuyer program. If you were a first-time homebuyer, you were looking at FHA. It's kind of pivoted away from that. Now it's more of a low credit score program. They'll go with a down payment of 3.5%. They require a credit score between 620 and 640. That's constantly changing due to the pandemic. They actually just changed it to 620. So I apologize, this slide is a little bit outdated. They just changed that back to 620. For a while, it was to 640. So more credit requirements, higher debt to income ratio requirements. They'll go higher than the 50% conventional wants to see. They'll go all the way up to 55% oftentimes. Okay. Advantages, again, credit flexibility quite a bit. It's honestly almost exclusively a credit score program now. And that's intentional. The government doesn't want to be in the business of doing mortgages. It's not their bread and butter. It's not what they want to be doing. So they've made it a little bit more expensive to get into that program. And now it really is kind of almost exclusively being used for high debt to income ratios or low credit scores. Shorter wait time after bankruptcies, foreclosures, short sales. They do not require 7 years to pass from foreclosure. It's 4 years. So they're a little bit more lenient on that stuff. Some situations with bankruptcies, they can do it as short as 1 year or 2 years after. So they do have shorter wait times after serious delinquencies. You can also use alternative credit. If you don't have a credit score, but you pay your bills on time, we can build up a credit history, alternative credit, and use that data potentially. Cons, monthly mortgage insurance can be twice that of a conventional loan. Big con, mortgage insurance doesn't do you any good. So paying twice for it is not great. You also have to pay both monthly as well as upfront. They get you twice, unfortunately. It's an expensive route to go. In addition, if you're not putting 10% down, the mortgage insurance on an FHA loan is permanent. You are stuck with it forever. Huge downside, huge downside. The only way to get rid of it is to refinance into a conventional loan that does not require it. Additional cons, tighter property restrictions. Quick story, my first day on the job in mortgage business, my manager, my loan officer I was working with said, hey, grab your stuff, we're gonna go to Home Depot. I said, I signed up to be working in a branch in a bank, why are we going to Home Depot? So we drove out to Home Depot and we bought chicken wire, and we drove the chicken wire, like we built out a chicken coop out of, and we brought the chicken wire out to a property, and we had to cover a window well because FHA was worried about somebody slipping and falling into an exposed window well. Kind of crazy. Conventional, yeah, they're adults. They'll deal with it. They'll cover it if they want to cover it, but otherwise, we're assuming they're not going to hurt themselves on an exposed window well. FHA, yeah, no, we assume somebody's going to hurt themselves. So FHA is a lot more concerned about health, safety, and livability concerns. If it does not meet construction requirements, then they're going to require it be taken care of. So because of these tighter property requirements, FHA can pose a little bit of a delay or a struggle in getting your offer accepted. It's a seller's market. The seller gets to decide a lot of what happens with the transaction. And that could come down to, we don't like FHA loans. We have a property that needs some work. We don't want to deal with it. We know FHA is going to call it out. So it could put you at a little bit of a competitive disadvantage if you're looking at FHA financing. In addition, and this is the single biggest drawback to FHA, and this is the reason we're not going to be talking about FHA for much longer in this seminar at least. Condos have to be FHA approved. Last time I checked, only 23 out of 208 complexes were approved in Boulder County. That sucks. If you're not one of those lucky 23 out of 208, you are not going to be able to get FHA financing. Okay, so it's a lot tougher process. They are less happy when it comes to condos. They're much more restrictive. And then it's a tougher process. It is a government loan after all. A government loan, government hoops to jump through. Yeah. All right. The third type of loan is what we call a portfolio loan. Portfolio loan means the investor is the institution you are getting the mortgage through. Okay, it is their own personal money. Minimum credit score, not applicable. We're going to decide what we do and how we do it. Max debt to income ratio, also not applicable. We get to decide our own guidelines. We get to decide our own rates and terms and everything else. It's our money. We get to decide how to lend it out. All right. Minimum down payment typically is 20%. Why would it be 20% down for a portfolio loan? And I also threw in the qualifier typically. I'm going to talk about the one exception to that a little bit later. But typically it would require 20% because if we're going with a portfolio loan, it's not because we want to, it's because we have to. And if we don't want to, but we have to go that, it also means it's not going to meet those mortgage insurance companies' guidelines. There's some reason why we can't go with conventional financing or we can't go with FHA financing that has us looking at a portfolio loan, okay? And if we have to look at a portfolio loan, it's simply not going to meet conventional, the mortgage insurance company's guidelines, okay? They have their own rules and regulations and they follow conventional or FHA guidelines, okay? Advantages, we get to establish our own guidelines within reason. It's not harking back to the housing crisis of 2008 where lenders were just, lending out money to anybody with a pulse. But we do get to decide our own guidelines. Okay, we're able to do loans that otherwise we wouldn't be able to do. We're going to be talking about that extensively. More property flexibility. Again, our money, we get to decide how to lend it out and on what we're lending out. Similar process to a conventional loan. It is a similar process to a conventional loan. Cons, higher down payment requirement. Also, we only do them as adjustable rate mortgages. So we'll do like a 7-year fixed ARM where the rate is fixed for 7 years and then it's subject to change. If we're going with a portfolio loan, there is an exception that we're trying to get. Okay, an exception for the property, an exception for the member or credit. And if we're going with a portfolio loan, it's meant to be a temporary solution. So get you into the house, get the issue fixed, whatever that exception is we're seeking, get that fixed and remedied, and then get you refinanced into a conventional loan. Okay, so we'll do adjustable rate mortgages, and they're also ruled on a case-by-case basis. We have to present a full file to what we call the loan committee. Loan committee is our 3 credit risk managers getting a room together and deciding based on our recommendation whether or not they're going to do the loan. So we actually do like a full write-up, we send it along to the loan committee, and then they decide on a case-by-case basis. And they generally want to see compensating factors. If we're going with a portfolio loan, again, we're asking for an exception for one piece. They typically want to see, okay, great, we're asking for an exception due to the credit. What do we have working for us that has us taking on that extra risk, right? Our members, our membership, you all, would not be super happy if we were just lending money out willy-nilly. We need to make sure that it makes financial sense, not just for the member, but also for the institution as well, okay? You all entrust yourself, or your money with us. We need to make sure we're taking care of that as well. All right. Thank you so much for hanging there with me through the different types of loans, the behind the scenes in regards to all the different terms. Now we're going to be kind of pivoting. I'm going to be explaining why we went through all that. Okay. So before 2008, when the housing bubble popped, lenders would lend out money, like I said, to pretty much anybody that had a pulse. My manager at the time, actually still my manager, he told me about stories pre-housing crisis when he worked for a larger institution. And they would do what they call ninja loans. No income, no job, no assets, and they would just give you a mortgage. He told me a story about how they, and this is where everybody kind of like drops to the floor, had a member with him, and he's like, yeah, great, I make $80,000 a year. So loan officer does their job, sends it through the system, it comes back within a matter of minutes saying, sorry, $80,000 doesn't cut it. It's not enough income to qualify for what you're trying to qualify for. He's like, sorry, did I say 80,000? I meant 120,000. So he runs that through the system, comes back, still not enough. Sorry, did I say 120? I meant 140. Runs that through the system, and the system finally comes back and says, yep, that works. And then the member said, I make $140,000. It was stated income, stated assets, whatever they said worked. They didn't have to verify anything. What could go wrong, right? So prior to 2008, extremely loose lending restrictions. That was one of the reasons why the housing bubble popped. It was way too easy to get a mortgage. Then, post 2008, the pendulum swung the other way. Way too easy to get a mortgage, and then it went to being way too difficult to get a mortgage. Over time, that pendulum has swung back towards the center. The pandemic threw a little bit of wrench in the works, and the pendulum swung back a little bit, where it was a little bit difficult to get a mortgage again. But again, slowly but surely, it's starting to swing back towards the center. So it went from way too easy to get a mortgage, no income, no job, no assets, not a problem, to what I called GUABS loans, give us a blood sample loans. It became way too difficult. Again, that pendulum swinging back towards the center, it is becoming balanced and fair and reasonable, in my opinion. So that was one reason the housing bubble popped. The other reason, the government blamed condos. The government blamed condos because they found out that when one unit gets foreclosed on or has a short sale, so a distressed sale of some sort, it decreases the value of all the other units in that complex. Now, when they sell that house, they have to do so at a discount to compete with the neighbor that just had a foreclosure. So the areas that were hardest hit, Southern California, Las Vegas, Southern Florida, these were areas where they had a large density of condos. One condo gets foreclosed on and it causes an avalanche effect within that complex. Okay, so the government said, look, we're still going to lend on condos, but we're going to make it more difficult. And that is why we have a seminar today. The vast majority of what we're talking about today is government guidelines with regards to condos. So what is a condo? That's a good question. A lot of people think condos and townhomes are the same thing or that they're interchangeable. You'll also hear people use the term apartment when they're talking about a condo, but there is a legal difference between a condo and a townhome. Okay. With a condominium, you own your specific unit and then you own an interest in the common areas. If you look at the legal address for a condo, they're usually identified in the same kind of structure. Unit X, building Y, and an undivided 1/200th interest in the common elements. That means you own 1/200th, that means there's 200 units. You own 1/200th of the tennis courts, 1/200th of the green spaces, 1/200th of that swimming pool. That's not like it's carved out. It's not like it has your initials on it. Hey, this belongs to Aaron Staufer. But you technically own a shared interest in the common areas. Okay. When you buy into a condo, you are belonging to the complex. You own part of the complex. But in regards to the unit, you own your specific unit. Drywall, in. Studs of the wall, in. You own the interior of your unit. Okay. A townhome, you legally own the land you're on. You legally own the dirt that you sit on. Okay. What can you do with the dirt? Nothing. It's what my dad would call a postage stamp. It's not big enough to do anything with it, but you technically own the dirt you're on. From the government's perspective, it makes all the difference in the world. Okay. So with the townhome, if you look at the legal address, you're going to see legal address that has lot and block. You own the lot you're on. Okay. If you're still not sure whether it's a condo or a townhome, you can check the county records, check the tax bill, and they will list out the value of the improvements, the structure, and then a value of the land. If it shows the value of the land, it's a townhome. You own the land that you're sitting on. Okay. People like to think of condos as one on top of the other and townhomes as side by side. Fair enough, right? You can't really own the land you're on if you have somebody above you. That being said, and the reason we go over this is because a lot of condos, or a lot of townhomes rather, they have what they call a townhouse style condo. It looks like a townhome. It smells like a townhome. It's side by side. You only have a neighbor on one side of you, or maybe both sides if you're an interior unit, but you don't have anybody above or below you. That should be a townhome, right? But if you look at the legal address, it'll say units and building. You legally don't own the land you're on. It is a townhome style condo. Okay. Ultimately, we care about the legal address. What does the legal address have? Okay. So keep an eye on that if you're looking at properties. Is it a condo or a townhome? So once you buy into a complex, who is in charge of managing it? How do you have a group of 200 people in this example? And how do they come to terms with what they want done? Hey, what contractor should we hire? Who's going to take care of the snow shoveling? Who's going to take care of the parking lot maintenance? There's painting that's due. There's siding that needs to be repaired. Who takes care of all of this? When you buy into a complex, you automatically belong to the homeowners association. Okay, the HOA, you belong to the homeowners association, whether you want to or not. Second you buy into a condo complex or a townhome complex, you are part of the HOA. You are a homeowner, okay? So the HOA, the homeowners association, they will oftentimes hire a management company. And we're gonna be talking about that shortly. The HOA operates though by collecting HOA dues from each of the owners. And then from there, they pay various different bills, okay? What the HOA fees cover will differ depending on the complex, and it differs drastically depending on the complex. When you're looking at a condo or a townhome, you really need to look at the HOA dues. What the HOA dues cover? What all does the association provide? Okay. HOA fees can include some of the following: insurance for the exterior of the complex. Very common. It's rare that we see a situation where the HOA dues do not cover insurance for the outside. Okay. Insurance for the inside of the unit. That's very rare. Okay. Typically, when you buy into a condo or a townhome, you're going to have to obtain what we call an HO6 policy. That's the technical term, HO6. Also, it's called a condo policy. Even if you're buying a townhome, it's called a condo policy, or a studs in policy. Means it's covering the studs of your wall in. The HOA is insuring the outside, the roof, the siding, the common areas, but you still have to insure the inside of your complex. The HO6 policy typically runs $25 to $50 a month, $300 to $600 a year. It's pretty affordable. It's similar to like a renter's policy, yeah, I guess it's probably the best example I can think of. It's very similar to a renter's policy or a contents policy. So pretty affordable, but you will have to obtain typically insurance for the inside. Occasionally, rarely, but occasionally, the HOA dues will cover insurance for the inside of the unit as well. Gas, very common. Electric, less common. Water, trash, recycling, very common. Typically, HOA dues will cover water, trash, and recycling. Common area maintenance, almost a guarantee. If there's pools, tennis courts, snow removal, it'll cover all of that as well. It's the thing I miss most about my townhome, if I'm being real honest, is the snow removal. It's winter's upon us, winter's coming. But yeah, with the townhome, 3 a.m. it'd be snowing and you hear people out there shoveling. Yes, that's great. It's awesome. I'm not gonna have to worry about getting out of my parking lot. Now when it snows, I'm like, okay, great. I gotta wake up an hour and a half early. Good times. Still dark out, freezing my tuchus off. So good times. So that's what HOA dues are. That's who is part of the HOA. The management company. The management company is a company that the HOA hires. Okay, so the homeowners will band together and say, all right, we're not capable of managing this. None of us are project managers. None of us are people that run budgets and are in charge of hiring contractors on a daily basis. We really need to get an expert on the case. So if it's an HOA that has it's relatively large, you will typically have a management company. The management company is employed by the homeowners association, by you, the new homeowner. Okay, you are their boss. Okay, and you will be able to fire them and hire them and shop around their services. All of that stuff you are able to do as part of the HOA. Very typical, they sign a contract, so they're a management company for a designated period of time. And then it comes up for renewal and you get to review them and decide if you want to have them keep managing your property or not. Have they been responsive? Have they been helpful? Have they been able to cut costs when in this very inflationary time period that we're in? They're in charge of maintaining the complex, as well as contracting other companies to handle ground maintenance. So it's not typically the management company that will go handle your snow removal. Okay, the management company will hire the snow removers. Okay, repairs to the complex. The HOA hires the management company. The management company will shop that around and actually handle that piece of it all. Okay, if you had an issue with your property that's on the outside or the common areas, you would contact the management company. The management company would then hire the people to do it. So they're an intermediate step. You are not dealing with the contractors directly. You're typically dealing with the management company who deals with the contractors. Occasionally it's a smaller HOA and they are self-managed. They will handle the hiring and firing of all these different contractors throughout the year and over time. Okay, but usually there's a management company that handles it. HO6 insurance. So I touched on that briefly. Again, you'll have to obtain insurance for the inside of your unit. The HOA dues cover insurance for the outside. Again, condo policy, studs in policy, HO6 policy, whether it's a condo or a townhome, you're going to have to obtain these types of policies. Again, I said $300 to $600 a year. That's pretty typical. Occasionally I'll see it as low as $250. Occasionally I'll see it as high as $800. Lenders will require it. So if you're getting a mortgage, you're going to have HO6 insurance. All right. So, Aaron, it doesn't seem like HOA or condos and townhomes are that different from a single family with regards to the lending side of things. So that you said, they were scapegoat for the housing crisis. Yes, they were. They are considered a scapegoat for the housing crisis, at least part of it. So it used to be pre-housing bubble popping, we didn't have to verify anything on a complex. Zero, zilch, nada, zero, nada. We did not have to verify anything. You went under contract and away we go. Once the housing bubble popped, the government said again, we'll still lend on condos, but they have to meet some very specific criteria. Specifically, it's these next 2 slides, okay? Once you go under contract on a condo, we have to fill out an HOA questionnaire. We have to reach out to the HOA, specifically the management company, and have them fill out a questionnaire for the lender, okay? We are looking for a number of different pieces, but how those questions are answered will decide whether or not the complex is what we call warrantable. Warrantable means, that's probably a term you haven't heard before. Warrantable means the condo complex meets the government's criteria. Okay, we are green lights ahead. We are able to go with conventional financing. Away we go. Okay. If it does not meet those government criteria, it is considered a non-warrantable condo. Non-warrantable condo. Non-warrantable condo means the government wants nothing to do with it. you only have one option, which is a portfolio loan. Okay. So what kind of questions are asked on the HOA questionnaire? I call it very clunkily. Clunkily? That's a word now if it hasn't been before. 0, 15, 20, 35, and sometimes 50. Okay. The rule of 0, 15, 25, sorry, 0, 15, 20, 35, and sometimes 50. I know it's not, doesn't roll off the tongue. I can't even say it twice the same way. But it is a good way to remember what we're looking for. Okay. So 0, when we send that HOA questionnaire off, we are going to find out if the complex is in any litigation. Is the complex in any litigation? Is the HOA suing anybody or being sued? Okay. We also want to make sure that it's not a condo town. So litigation, the most common litigation that arises is builder defects. Okay. The builder cut corners when they built the property, allegedly, and now they are being sued. Okay. The HOA, again, you belong to the HOA, is suing the builder because of the defects that are in the property. Okay. It could be drainage issues. It could be siding issues. We've had a couple arise recently where the complex looks very pretty because it mixes a bunch of different types of material. So you might see brick intermixed with like stainless steel or corrugated steel mixed with different types of woodwork. That can pose issues with regards to mold, with regards to cracking, with regards to settling. All that stuff can pose potential issues. So if there's litigation that arises, why does the lender care about that? Our concern is that the litigation is going to cause the HOA dues to increase to a level where people will no longer be able to afford those units, or perhaps the HOA dues are increased, not so much that people can't afford them, but so that the properties are less marketable. If your HOA dues went from $250 to $500 per month, yeah, there's probably going to be fewer people that are going to be wanting to buy those properties. Ultimately, we care about the collateral. We care about what the property is you're buying. Okay. So litigation can prove an issue. It could also be a health, safety, or livability concerns. Yeah, there's drainage issues that causes our entire parking lot to become an ice rink. Well, that could lead to further lawsuits. That could lead to some people hurting themselves. And we do care about you and your well-being. So litigation can be an issue. I say can be. Sometimes it's a matter of somebody slipped and fell and they're suing the HOA for $10,000. If they have insurance coverage of $100,000 and there's a slip and fall for $10,000, it's not going to be an issue. Okay. But it does depend on how extensive the litigation is and how far you are in the process of the litigation. Litigation can take quite a while. Blue Sky Condos in Erie, man, 2007, 2008, my brother bought one of those brand new construction and he became a board member on the HOA. So when you become part of an HOA, you can actually run for office. You can become a board member. There's a treasury for the HOA. There's board members. They are, the primary decision factors. So you get a vote for them, and then they get a vote kind of on behalf of the homeowners. So he decided, I think I might want to get into politics. I'm going to join the HOA board. Oh man, when they were going through litigation, every single board meeting, every single HOA meeting, it was just a scream fest. People were livid. People could not get mortgages. People could not sell their homes. It was just a nightmare. So he quickly decided he did not want to become part of politics, and he switched careers. So yeah, litigation can be really damaging. It can drag out for years and years and years before it gets resolved. That means you might have to be staying put for years and years and years. So litigation can be a really big issue. It pops up occasionally. I've come across it a couple times already this week for different complexes. So it cannot be a condo-tel. I mentioned that kind of in passing. So if you're a skier or a snowboarder and you go up to Winter Park or Estes or whatever, you'll come across these condos that look kind of like a condo, but it also kind of looks like a hotel and you're not sure which one it is. You walk in and there's a doorman, and then there's a concierge desk. And at the concierge desk, they will also arrange for rentals for you. It's what we call rental pools. So owners of a condotel will say, hey, yeah, I'm going to be there Monday through Wednesday, but I'm not going to be there Thursday through Sunday. So condo complex, feel free to rent that unit out when I'm gone. They will arrange for cleaning services. They will rent out your property for you on the days you're gone. So they'll enter in the rental pool. And then if somebody comes in and wants to rent your property, they can rent your property. So it's kind of like a condo, kind of like a hotel. That's a condo town. The government does not want anything to do with condo towns. Okay. 15. The complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. That was not an issue for a while, for a good while. It actually used to be 30 days, and that was problematic. I remember a real estate agent, I approached her and said, "Hey, I'm sorry, this is a non-warrantable condo. There's too many units that are delinquent on HOA dues." She's like, "Well, how many?" I'm like, "It looks like 3 units. 3 units are over the limit. So 3 more units are delinquent than are allowed." She said, "Great, give me 3 days." 3 days later, she comes back to me and she says, "Hey, go ahead and pull that condo questionnaire again." And I pulled the condo questionnaire and everything was fine. She had gone in and paid a few people's HOA dues to bring them current, so that the complex went from being non-warrantable to warrantable. Ultimately, I don't care how it gets done. I just need to make sure it's warrantable if we're going to go with conventional financing. The government has since then changed it to 60 days, and they also changed it from 10% to 15%. So they did make that a little bit easier, and that has been a lot better. I did have a complex last year come up as non-warrantable. It was right when the pandemic broke, and HOA bills were one of the first bills that stopped getting paid. And for a few months, that HOA complex was non-warrantable. They're back current, everything's fine again. But for a while, there was non-warrantable. Why does that matter to the lender? If too many people are missing HOA dues, it's going to lead to potentially foreclosures, short sales. It could lead to people having to sell their houses. It could lead to an increase in HOA dues. All of that stuff can affect marketability. Okay. 20. The complex cannot have one owner who owns 20% or more of the units. Why do you think the lender would care about that? If there's land barons who own a bunch of units. The reason why is because we're worried that that one owner who owns 20% of the units is going to go into bankruptcy, and then they're just going to flood the market with 20% of the units, right? Flooding the market with inventory, just like the original concerns that the government had around cascading effect, an avalanche effect. An influx of rent listings for sale could drag down values. Supply and demand, too much inventory, not enough supply, that could drag down the values of your property. And if you had to sell your house, you'd be competing against 20% of the units. That could be a problem as well. The government does carve out one exception for that, which is if the owner of the 20% of the units is a municipality, City of Boulder, affordable housing. Sometimes they acquired more than 20% of the units for subsidized housing, low income rents. The government allows for that. They know that that person or that entity is not likely to go bankrupt. Okay. 35. The complex cannot have 35% or more of the complex be commercial in nature. Steel yards in Boulder, right downtown. Bottom half is commercial. Chiropractic offices and dentist offices and whatever. And then the top half is residential. So it's 50-50, 50% commercial, 50% residential. That is a non-warrantable condo. You cannot get conventional financing with that, okay? Why does the government care about commercial space? Again, each of these has a very specific reason. The complex cannot have 35% or more of the square footage be commercial because commercial inventory can sit on the market for a long time. If you've ever driven past a commercial space and you're like, that place is still vacant, it's been vacant for a year and a half, what is going on there? Yeah, when commercial goes vacant, it tends to be vacant for a while. People are not going to be really inclined to move above vacant commercial space. Number one, it could be a bowling alley that goes in there. It could be a gun range. And now you have to deal with the sound of muffled shots all night. So yeah, that would not be great. So what's going on? It could be hemp industry. It could be a restaurant with odors that you do not like. There's a lot of reasons why the government does not like commercial space because they're not in the business of commercial financing. Commercial financing is 100% portfolio loans for this very reason. So they're just not sure what's going to go into the commercial space when the time comes. Commercial space can be vacant, which can pose issues with regards to saleability. A lot of this has to do with marketability. And sometimes 50. All right. When the purchaser of the unit is an investor, at least 50% of the units must be owner occupied. That's a huge one. And it's by far and away the most common reason a property would be considered a non-warrantable condo. Okay. Is because more than 50% of the units are investor owned. Now, this does not apply if you are going to be an owner occupant. If you are going to be living in the property, this does not apply to you. This only comes up if the person who's buying the property is an investor. There's one big caveat here. Some lenders will tell you differently. A lot of lenders will tell you differently. A lot of lenders will tell you it does not matter if you're going to be living in the property or not. We care about the owner occupancy ratio in the complex. That's wrong. They're not abiding by Fannie Mae and Freddie Mac, conventional financing. They are having what we call an overlay. An overlay is a requirement above and beyond the government's requirements. The government does not require that, but the bank may. The bank has their own guidelines that they are putting on top of the conventional guidelines. It's called an overlay. So if you ever hear that, hey, I'm going to be living in the property. Yeah, it's non-warrantable. I'm sorry. Hang up the phone, call somebody else. I'd be happy to help you. Okay. We do not have that overlay. We do not have that requirement. If it could be 99% investor owned. It's also logical, right? If you're living in the property, why does it matter what the ratio is? You're either keeping it the same or you're improving it. Exactly right. It's logical. It's right. It's fair. It's also what we go by. Okay. Why does the government care about how many units are investor owned? Yeah, if a complex is too investor owned, there's a number of reasons. One, homeowners tend to take care of their own property better than they take care of an investment property. They're not living in it. They're not there every day. They don't see what's wrong with the property. So owner occupied properties tend, not always, but tend to be better maintained than investor owned property. Okay. Investors are renting the properties out to college kids who are beating the crap out of properties. Okay. Number two, turnover. Turnover. Average homeowner lives in their house about 7 years. Investors, yeah, it's a year or two. They churn. They move in, they move out. So there's just more volatility within the complex as well. Okay. So yeah, those are the reasons why the government has us fill out an HOA questionnaire. Those are the questions that the lender cares about, and those are what we're looking for. So, logical next question. How do you know if a complex is warrantable or not? How do you know before you start looking at all these condos whether or not a complex meets those criteria or not? You probably don't. Your agent is not likely to know the answers to these questions. Okay. Sometimes they will advertise them online. This is a non-warrantable condo. But if you ask them why, they may not know, or the answer they give you is this one, in which case it doesn't apply to you if you're going to be living there. So for the most part, you don't typically know. However, your lender may. Okay. I highly encourage you. Elevations is only based in Colorado. We only do mortgages in Colorado. We keep a vast database of condo complexes. We're the #1 credit union lender in all of Colorado. So there's a good chance that if you're buying a property in a complex, we've done financing in there. And if it's not the case, I'll let you know that too. But we have a vast database. We very well may know if it's warrantable or not. I've got some people who will send me a list. Hey, look, are the following complexes warrantable or not? We do some research and let you know what information, if any, we have on it. So ask your lender. We're more likely to know than the real estate agents are. Okay. All right. So all this talk about condos. Well, do lenders care about townhomes? Do we have to fill out an HOA questionnaire for townhomes? No. Townhomes make all the difference in the world. With a townhome, we do not have to ask a single question. Not a single question. We don't have to care about owner occupancy ratios. We do not care about delinquency on HOA dues. We do not care about anything. It's why I made such a point out of differentiating condos from townhomes, because they follow two very different sets of rules. It's also the reason, as an investor myself, I own 5 townhomes as investment properties, because townhomes don't have to meet that condo requirement. They don't have to go through those hoops. Townhomes are a little bit more expensive. There's fewer townhomes available. Most properties in and around Boulder, in and around Denver, are condos. They're built one on top of the other to conserve space. Okay. So with the townhome, the lender does not need to complete an HOA questionnaire at all. We do not have to ask a single question, not one. Again, keep in mind, some condos look like townhomes. Looks like a townhome, smells like a townhome. It may not be a townhome. Okay. Look at the legal address. The legal address is critically important there. All right. So buyer's considerations. There's buyer's considerations. There's lender's considerations. What should you be looking for? What did the lender look for? For the buyer's considerations, is the HOA well managed? Do the homeowners actively participate in the HOA? When you go under contract on a condo or a townhome, you are going to be receiving what they call CIC, Common Interest Communities, CIC. You're going to be receiving CIC documents, okay? It's going to be a gigantic amount of information, okay? You're going to be seeing budgets for the HOA. You're going to be seeing sometimes what they call reserve studies. You're going to be seeing the minutes from the most recent meeting. The minutes are literally the HOA getting together and saying, hear ye, we bring this meeting to order. Let's review the minutes from the last meeting. It's very weird. They go through the entire process like it's an old school board meeting. So you're going to be receiving, again, budget, reserve studies, minutes. You're going to receive the covenants. What are you agreeing to? When you move into that complex, what are you agreeing to? What are the rules and regulations within the area? Okay. On the minutes that you receive, they're going to recap how many people are present for the meeting. And how do I know when the meetings are? Trust me, you'll know when the HOA meetings are. You're going to get emails and letters all saying, hey, look, we're having an HOA, quarterly HOA meeting. We're meeting on this day at this place and this time. So, on those minutes, though, one thing I always look for when I'm buying a property in an HOA is, are the homeowners actively participating in the HOA? There's a little bit of a balancing act there. When I used the example of my brother when he was on the HOA board, and if you saw the HOA minutes, you would see, hey, 100 homeowners out of 125 are present for the meeting. That's bad. That is a red flag if I've ever seen one. If that many people are taking time out of their precious, day with their kids' hockey and everything else to go attend HOA meetings, which are admittedly not very exciting, it means something is going wrong. Okay. In this case, there was litigation and everybody was showing up because they wanted to figure out what was going on. Too much participation in an HOA could be a red flag. Unless people love each other that much and they're just getting together to, shoot the breeze, it's probably a red flag. Okay. I want to figure out what's going on with that HOA if there's too much participation. Conversely, too little participation, when they say, yeah, literally nobody showed up for these meetings, that could be a little bit of a red flag. Why would that be a red flag? It may or may not be. Call it a yellow flag. I just want to get more information. Is the HOA so well run that literally nobody's showing up for the meetings because everybody's happy? Or is it because they do not have an interest in participating in their HOA? That is a problem. There's numerous stories about HOA boards not being held accountable correctly and ruining the HOA's finances. There was Indian Peaks Townhomes in Lafayette. I owned one of the single family, but there was a townhome complex right near it. And I was chatting with one of the people who was on the board, and they're like, they were not being managed correctly. They were not monitoring the budget. They were not handling the money correctly. They were not hiring the right management company or the right contractors. And because of that, the HOA was in financial distress for a number of years. They were able to get things sorted out and fixed. But that's a problem. If there's not enough participation, people are not being held accountable correctly. Okay. So too much or too little participation, I'm more concerned about too much than too little. But if there's too little, I want to talk to the management company. What's going on? And I have no problems reaching out to the management company, the property manager, and saying, hey, you manage more than one property. How are things with this one? They'll tell you. They'll tell you very honestly. Things are going great here. We haven't had any issues. The budget's right intact. We've increased the HOA dues regularly to keep our budget in line, but everything's going very well. Love to hear that. Is the HOA in good financial standings? On that same note, right? Do they have sufficient financial reserves? Lenders want to see that the HOA is setting aside 10% of the amount that they're collecting each year or month towards reserves. Reserves are for, look, we're planning for the sprinkler system to be repaired. We're planning for our siding to be due in the next 5 years. Roofing is about 10 years out. Well, what if there was a hailstorm and we had to pay for that deductible for the insurance claim? Does the HOA have enough money set aside for everything else to handle that? Reserves are break glass in case of emergency. We are setting money aside for an unknown issue. Okay. They are setting aside money, additional money than they need for any occurrences that could surprise them. Okay. And those are happening all the time. Hailstorms have been really bad the last few years. Knock on wood, not so bad this year. Have they recently or ever imposed any special assessments? A special assessment is the HOA saying, we have not been collecting enough money. We need to be collecting more money. I referenced Indian Peaks. They had to have a special assessment done. They were not setting aside enough money. They had to refill the coffers, replenish those funds, and they decided to do so with a special assessment. A special assessment is the HOA fixing their books by increasing HOA dues temporarily. So you have your HOA dues, which are the base fee, and then you have your special assessments, which are above and beyond that. They are also for a finite period of time. We're going to collect an additional $100 per month for 24 months from each unit, something like that. When you're going to buy a property with a special assessment, it's also a point of negotiation. Who's going to be responsible for that? Sometimes you can negotiate to have the seller pay for it. Sometimes that's your responsibility. So make sure you're finding out if there's a special assessment and getting clarity on whose responsibility it is going forward. A single special assessment may not be the end of the world. The HOA is getting fixed. I like to see that they're getting fixed rather than not. However, if they do special assessment after special assessment after special assessment, that's a serious concern. They probably should just be increasing their HOA dues if they're going to have a constant special assessment in place. So ask them, find that out. It's going to be on the budgets. It's going to be on the minutes. Ask the property manager. Always call the property manager and ask these types of questions. Okay. How often have the HOA dues increased in the past? People automatically assume increase in HOA dues is a bad sign. I completely disagree. There's inflation. There's inflation. If you've tried to book a vacation recently, or if you've tried to buy a car, inflation is real. Things are more expensive, okay? And that will happen naturally over time. Things get more expensive over time, okay? Bread does no longer cost a nickel. So inflation happens, things become more expensive. Increase in HOA dues is a reflection of that, or can be at least, okay? Yeah, you know, everything's going fine with the HOA. However, if we keep on our current course, we're gonna run out of money. We need to increase HOA dues on a yearly basis, typically, to account for those increases in costs. Very common increase is, oh yeah, we're gonna have to increase HOA dues $10, $25, $50 a month. $50 would be on the high side. If they're increasing the HOA dues that much, I want to get information as to, okay, great, what's going on here? What happened? What surprised us? Where were we not planning accordingly and correctly? But increasing HOA dues by itself is not a bad sign. In fact, there's actually a sign that it might be a good thing. The HOA, the management company, are actively monitoring the budget, right? They know how much they need to create. They're not just leaving HOA dues at 175 for eternity, and then there's issues beyond that. They are actively monitoring the budget and they know how much they should be collecting. So, not necessarily a bad thing, but you want to find out how much have they been increasing, how often have they been increasing. Okay, those are two pieces of information I do want to get to the bottom of. Are the HOA dues a good value? What all do your HOA dues cover? We talked about some of the things they cover and some of the things they may not cover. But are you going to use those amenities? Are your HOA dues paying for tennis courts and you do not like tennis? Are you scared of the water and your HOA dues cover a very lavish pool? Yeah, you're paying for somebody else to enjoy it. You don't get to pick and choose. You don't get to choose what you will and will not cover. When you buy in the HOA, those are your HOA dues. You're on the hook for them, okay? And if you're not enjoying the pool or tennis courts, you're paying for somebody else too, okay? So ask yourselves if they're a good value. In Boulder to Denver area, I usually use 250 as my base point for where HOA dues are. They're going to vary complex to complex. Newer complexes, their HOA dues may not be as expensive because everybody's buying into it. Brand new roof, brand new siding, brand new pool, everything's brand new. Less maintenance is going to occur. Okay. If you have an older complex, your HOA dues may be higher. Okay. So keep an eye on that. What are your HOA dues covering, and is it going to be a good value for you? Are you going to use the amenities that they are providing? Is the HOA overbearing or underbearing? One thing I always do, I always talk to the property manager, get the nitty-gritty from them. How are the meetings going? How many people are participating? What is your opinion of the HOA? Are they well managed? Yeah. I'm also talking to homeowners. When I get past inspection and there's a good chance I'm going to buy the house, knock on a couple doors and just say, hey, I'm going to be potentially your neighbor. I'm under contract to buy the unit next door. I just want to get your opinion, your 2 cents. How's the HOA? That's all you need to say. If you shut up, they will talk to you and talk to you and talk to you. People love talking about their HOAs. I can't believe they were all over me for having my trash can out for an extra day. They came out and measured my weeds. They said they could be 1.5 inches. And it turns out they were 2 inches. They literally measured my the weeds, my house. People love talking about their HOA. And if they don't have anything to say, great, all the better. But is your HOA overbearing or underbearing? Okay. How rigid are the HOA covenants? When you get the CIC documents, budget, reserve studies, minutes from the meetings, and the covenants, you really need to read the documents. Please, 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 please read the documents. It is not a fun read. They are boring, but I've always done so on every single complex I've ever bought into. I've also backed out of contracts because of the HOA covenants. Okay. I had a couple people buy properties without reading the covenants, and they found out, oh, the HOA allows one dog up to 55 pounds. I've got two dogs. Yeah, that's a problem. You either need to give away a dog or you need to move and sell your house. The property you just bought, that is a terrible position to be in. So spend your time, read the covenants, okay? And then ask your neighbors how what their opinion is of the HOA. They will tell you the truth. People love talking about their HOA. Better or worse, they love talking about their HOA, okay? Are the grounds and buildings well maintained? I came across a complex in Boulder and the HOA dues were $650 per month. Oh, it was ridiculously high. But the HOA was not taking care of the property. The trees and the bushes were running rampant. The roots from all the trees were causing issues with the parking lot. The paint was peeling. I was like, what are they paying $650 per month for? It's not going towards the stuff it should be going towards. Like, what is it going for? That's a situation where the HOA is underbearing. They're not taking care of the property the way they should be, and they're charging you an arm and a leg to do so. So again, ask your soon-to-be neighbors. They will tell you the truth. People will do not hold back when it comes to the HOA. Another consideration, is the complex going to maintain its value? I've had people before where they're like, yeah, I love the fact that it backs open space. I'm like, hold up. What are they going to do with that open space? Is it actually open space? Is it Chautauqua Park and they can't develop it? Or is it open space that's going to be developed in T-minus 2 days and you're going to have another complex behind you? Those views you have currently, those might be going away. So if there's open space around you, find out, is it going to be developed in the near future? And if it is, what could it possibly develop into? Ask as many possible questions as you can. Okay, now's the time to do so. Once you go into contract, that is the due diligence period. Roll up your sleeves and start asking questions. How comfortable is the complex? Can you hear road noise? Can you hear dogs or neighbors when you're in the unit? This is a little bit of a difficult subject only because neighbors and dogs come and go. You could move into your unit with a noisy neighbor and they're gone the next day, or they could be there for 25 years. So you don't necessarily know all those answers, but how thin are the walls? Is this going to be a constant problem? You can't control who your neighbors are, but is the complex well built and kind of shutters out some of that noise? Road noise. A lot of people make the mistake of going for their inspection or going for their appraisal or their showings midday. Yeah, well, I'm going to duck out at lunch and go take a look at this property. That's okay. You're going to notice the parking lot is empty because everybody's at work. You're also not going to notice a lot of road noise because it's lunchtime and nobody's driving. I highly recommend you to go back at a different time the next time. Okay. If you schedule your first showing for noon, make sure your second showing or your inspection is scheduled for later in the day when people are coming home. You want to experience what it's going to be like living in that property. So go there at different times of the day when the parking lot is most likely to be full, when the road noise is going to be at its highest level. Try to get out and visit the property at different times. Stagnate those appointments so that you can really kind of have a better experience of what that complex is going to be like. Okay. Again, I don't necessarily make a judgment just based on dogs or neighbors in the area. But if you can hear every pitter patter of every step above or below you, yeah, it may not matter who's living there. You're going to be dealing with that constantly. All right. That is the class. I'm sure Michelle has some questions for me. There's always questions. I love the questions. Questions are my favorite part. And Michelle's muted.
Well, there we go. Because boy, I'm learning so much, and you are so right about the HOA. You can just stop a neighbor and find out so much about how it works, who's involved, and also about the condos and the townhome. You can find out so much about the whole area just by tracking down a few neighbors that are in the area and just asking them those questions. And they're usually more than happy.
It's like talking weather. It's like talking weather. If you're looking for small talk, weather, HOAs, they're going to have something to say about it.
Absolutely. And congratulations on your promotion, Erin. I didn't see that, and I'm so proud of you. So that's awesome. Well, everybody, if anybody has any questions you can place them in the Q&A right now. And if we don't see any, like I said, I'll be sending a follow-up tomorrow morning. And you've got Aaron's and my email addresses. Please, if you ponder and come up with a question, we are most certainly available to answer those questions, preferably Aaron. But we will get you to the right people, and I know Aaron will provide those answers. So with that, I'm not seeing any, Aaron. So, but great information. And it becomes quite apparent when you're applying for the mortgage or qualifying or out there, investigating houses, all these differences. So it's so informative and educational, but it really helped me, and I'm going to share it with my daughter as well. So, and her boyfriend. So, well, there is a question. Let's look here. Thank you so much for the useful info. Are the CIC documents available before negotiations / are they public?
Good question. So sometimes they're made public. You can go on the HOA's website and you can pull up all the documents from the recent. A lot of times they only make them available to homeowners or soon to be homeowners. So it depends on the HOA and how much they have it locked down. I will say Colorado is what we call the wild, wild west. You go under contract and then you start asking questions. You go under contract and then you do your inspection. And then you do your appraisal. And then you get your loan approved. And then you check on the SCIC document. So most of that stuff is done once you're under contract on a property. I do have people occasionally come up to me and be like, I want to do an inspection before I go under contract. It's not how it's done in Colorado. You go under contract first and then you start asking questions. So it may or may not be available on the HOA's website. As a real estate agent, putting on my real estate agent hat for a second, asking for that stuff ahead of time could be a detriment to getting your offer accepted. They may view that as, here's something that's going to be a little bit more difficult to work with. I'm not saying they necessarily would, but they could. In this market, any leverage you can get when it comes to negotiating the house, the better off you're going to be. So I try to make things as easy as I can until I'm under contract, and then I start going out. And then I start asking questions. So possibly, it just depends on the HOA. Yeah.
Well, great. And there was another question about the PowerPoint slides and the video, and I will be sharing it again in the follow-up for tomorrow. So, but Aaron, so if you are in the process of purchasing a condo or a townhome, the inspection always happens in the state of Colorado after it goes under contract?
Yeah, once you're under contract is when you start asking questions, including doing your inspection. It's one of the first things you do. You go under contract and then you schedule your inspection right away. So it's usually scheduled in the first few days.
So what if you hire your inspector or you're worried about anything coming back? Is there any way to get out of that contract?
It's a great question. So the Colorado contract is extremely buyer friendly, extremely buyer friendly. You go under contract. If you do not like the inspection, cancel. You get your earnest money back. You do your appraisal. If you don't like the appraisal, cancel. You get your earnest money back. A loan termination deadline at the buyer's sole subjective discretion. Sole subjective discretion. It does not get more vague than that. You can cancel. You can get your earnest money back if you do not like the terms of your loan. And they do have a CIC documents deadline. So they have a deadline by which they have to provide those documents to you and a date by which you can object to those documents as well. So yeah, it's extremely buyer friendly. Lots of ways to get out of the contract based on those deadlines.
Okay, so I have one more question. What if you wanted to have access? Are you able to hire your own just inspection person to come in before it, just to make sure that, or?
Not typically. Well, I mean, so you'll definitely hire your own inspector, but you typically hire your own inspector once you're under contract.
After you're under contract. Okay, that makes sense.
So it's like the ink is dry on the contract, and then you hire your inspector right away. And the reason you do it right away is because if a deal is going to fall apart, it typically falls apart due to inspection. It's the number one reason why a contract would fall apart is the inspection.
Okay, that makes sense. And that's why I was saying, like, people are getting very desperate with these houses going under contract or condos or townhomes and way over asking price. And I was so surprised to waive the inspection because I didn't know how they would do that. What if something came back? But that makes total sense. Thank you for pointing out those buyer's laws, sure, because that's super helpful. So, well, I think that we have got, that one's done. Well, guys, we just want to say thank you for joining us today. I hope you have a wonderful rest of your afternoon. Thanks again, Erin. And it is my time to say goodbye, everybody. Have a great afternoon. And thanks again.
Thank
Bye.